For almost 50 years, the United States enjoyed something almost no one truly understood: a global free lunch paid for, in large part, by the rest of the world. It did not look like a free lunch when you watched the news or walked through a shopping mall. It looked like normal life. Endless rows of products made overseas, but bought with dollars comfortable. Suburbs filled with houses built on cheap mortgages, a government that always seemed able to find more. Money for wars, rescues, stimulus packages, and social programs. Beneath this everyday reality, one quiet mechanism was at work, silently shaping prices, trade, and power. The link between the US dollar and the world's most important commodity, oil. This arrangement is what people call the petrodollar system, and for decades it helped America live beyond what its own production alone could justify. The idea is simple on the surface, but profound in its impact. When oil is priced and sold almost exclusively in US dollars, any country that needs to keep its lights on, its factories running, and its trucks moving must first get dollars. Central banks stockpile them. Companies borrow in them. Governments worry more about dollar exchange rates than about their own neighbors' currencies. This constant global demand for dollars gives the United States a unique advantage. It can issue the money that everyone else needs. When America runs a deficit, it does not have to scramble for foreign currency. The world already wants its debt because the world already needs its dollars. That is how a free lunch begins. One country gets to borrow cheaply and spend heavily, while others accept its paper in exchange for real goods and hard work. Most people living inside this system never see it. They notice rising or falling gas prices, but they do not think about what currency oil is invoiced in. They hear about interest rates, inflation, and government budgets. But they rarely connect those things to deep long-term structures built decades ago, in political backrooms and diplomatic meetings. Yet if you earn in dollars, save in dollars, import goods priced in dollars, or live in a country where a crisis in the United States quickly spills over into your own economy, then the petrodollar system has touched your life quietly and continuously. Today, people are increasingly talking about the end of that system. Headlines and commentators throw out dramatic phrases: the petrodollar is dead, the dollar's dominance is over, a new financial order is coming. Some of this talk is exaggerated, some is marketing, and some is rooted in real changes in how countries trade energy and hold reserves. But whether the petrodollar truly dies or simply fades, one crucial fact remains. A long era in which the US dollar sat unchallenged at the center of both finance and energy is slowly, steadily shifting. To understand what that means for the next 10 or 20 years, you first have to understand how we got here. The story does not begin with oil. It begins with gold, with trust, and with a moment when the United States quietly broke a promise to the world and had to find a new anchor for its currency. Only then does the logic of the petrodollar and the magnitude of America's free lunch really become clear. As you move through this story, remember that none of these arrangements were inevitable. There were choices made by leaders responding to crises, seeking advantages, and trying to preserve their own power. Different decisions could have produced a very different global order. The fact that most people never heard about the petrodollar system while it was at its strongest does not make it less real. It simply shows how much of modern life rests on hidden agreements and quiet incentives, rather than on open debate. Now that those foundations are shifting and more people are finally asking how the dollar came to hold such sway, you have a rare chance to see the machinery behind the curtain. Understanding it will not change the past, but it can change how you interpret the headlines in the present and how you prepare for the future. From gold to oil, a new anchor for the dollar for decades after World War II. The global monetary system rested on a simple structure. Most major currencies were pegged to the US dollar, and the dollar itself was pegged to gold. This was the Bretton Woods order. Foreign governments could hold dollars, confident that, in theory, they could convert those dollars into a fixed amount of gold from the US Treasury. As long as that promise held, the dollar was more than paper backed by faith. It was a claim on something scarce and universally valued. Over time, however, the United States began to stretch the system. The country was spending heavily on the Vietnam War, expanding social programs at home, and investing in a vast global presence. Dollars were flowing out across the world faster than gold was flowing in. Other nations, especially in Europe, looked at their growing piles of dollars and started to ask a dangerous question. What if there are more dollars in circulation than the gold backing them? Some of them began to act on that suspicion, sending dollars back to the US and asking to be paid in gold instead. By the late 1960s and early 1970s, the pressure became too intense. The United States faced a dilemma: either drastically tighten its own spending and raise interest rates to defend the dollar, linked to gold, or admit that the promise could no longer be kept. In August 1971, President Richard Nixon chose the latter path. In a televised address, he announced that the U.S. would suspend the convertibility of dollars into gold. In practice, this meant that the dollar was no longer anchored to anything tangible. The gold window had been slammed shut. The world now faced a startling reality. The reserve currency at the center of global trade was, from that moment on, a fiat currency valuable only because people believed in it and used it. The question on many policymakers' minds, whether they said it publicly or not, was straightforward. If the dollar is no longer tied to gold, why should we keep trusting it as the foundation of the system? How could the United States maintain the dollar's special status without the discipline of a metal standard? Almost on cue, another crisis struck: the oil shock of 1973. The OPEC oil embargo sent prices soaring and reminded every nation that energy was the real lifeblood of modern economies. Lines at gas stations grew longer. Inflation surged. Growth faltered. The word stagflation entered the economic vocabulary, capturing the painful combination of stagnant output and rising prices. It was a period of fear and confusion, but for strategic thinkers in Washington, it also presented an opportunity. If gold was no longer the anchor for the dollar, perhaps oil could be. Unlike gold, which mostly sat in vaults, oil moved through pipelines, tankers, and refineries every single day. Every country needed it, and demand for it was not going away. If the United States could find a way to ensure that oil was priced and traded in dollars, the world would still have a powerful reason to hold and use the American currency. The dollar would lose its link to gold but gain a new foundation in the commodity that drove the modern world. The stage was set for a new kind of arrangement. One that would tie the value of paper money not to a metal, but to energy and security agreements. At the center of this emerging design stood one key partner: Saudi Arabia. It's the largest oil exporter in the world and a leading voice within OPEC. What came next would quietly transform the dollar from a former gold-backed currency into the king of oil, and in doing so, it would create the conditions for America's decades-long financial free lunch. The Petrodollar deal: oil, security, and recycling dollars in the mid-1970s. As the dust from the oil shock was still settling, the United States and Saudi Arabia began to shape an understanding that would become the backbone of the petrodollar system. On the surface, it seemed like a straightforward exchange of interests. The United States would offer military protection, political backing, and access to advanced weapons. In return, Saudi Arabia would use its position as the leading oil exporter to reinforce the role of the dollar in global energy trade. The essential logic of the arrangement can be described in a few key steps. First, Saudi Arabia would agree to price its oil exports exclusively in US dollars. If Japan, Germany, or any other country wanted Saudi oil, it would have to obtain dollars on the foreign exchange market. Second, other OPEC members, influenced by Saudi leadership and the practical convenience of using a single currency, would follow a similar model. Over time, the norm would emerge. International oil contracts are denominated in dollars. Once that norm took hold, a powerful dynamic was created. Because every country needed oil, every country needed dollars. Central banks, state-owned oil companies, and large private firms around the world started to hold significant dollar reserves, not just for trading goods with the United States itself, but specifically to be ready to buy energy. The dollar was no longer just the currency of one country. It was the ticket required to access the world's most vital resource. The second component of the deal involved what happened to those dollars after Saudi Arabia and other oil exporters earned them. Rather than spending all of their revenue immediately or keeping it idle, they began to recycle petrodollars back into the American financial system. They bought us treasury bonds, deposited funds in US and European banks, and invested in Western assets. This recycling process meant that dollars paid out for oil imports often returned to finance US government deficits, corporate borrowing, and financial markets. The United States thus benefited in two ways at once. On one side, global demand for dollars remained strong because energy was priced in its currency. On the other side, the very countries earning those dollars used them to purchase American debt, keeping us borrowing costs relatively low. The U.S. could run large trade deficits, importing far more than it exported without facing the same immediate market punishment that other countries would suffer. Its IOUs were constantly absorbed by nations and institutions that needed dollar assets. For Saudi Arabia and other oil exporters, the system also brought advantages. They gained security arrangements with the world's dominant military power. They obtained steady access to Western technology and investment. Their financial surpluses found a deep liquid home in dollar-denominated markets. The relationship was not equal, and it carried political tensions. But for decades, it was stable enough to endure wars, revolutions, and crises. Over time, the petrodollar system became so embedded in global finance that many people stopped noticing it. Economists discussed capital flows and bond markets without always tying them back to the original deal. Commentators talked about U.S. deficits as if they were simply a matter of domestic policy choices, ignoring the international demand that made those deficits sustainable. Yet beneath the surface, the same basic mechanism kept running. The world bought energy in dollars. Oil exporters recycled those dollars into U.S. assets, and America enjoyed a level of spending power unmatched by other nations. This is the world most of us grew up in. However, no system lasts forever. Political interests shift, new powers rise, and old assumptions begin to wobble. Slowly, then more visibly, cracks started to appear in the foundation of the petrodollar order, signaling that the free lunch might not last indefinitely. Cracks in the system, how the petrodollar began to erode for many years. The petrodollar system seemed almost unshakable. The United States was the largest economy and the dominant military. The dollar was deeply embedded in trade, finance, and central bank reserves. And oil, the lifeblood of industrial society, was reliably priced in U.S. currency. But beneath this appearance of permanence, forces were slowly gathering that would challenge the arrangement. No empire stays at its peak forever, and no monetary order remains untouched by change. One source of pressure came from within the United States itself. Taking advantage of its privileged position, America ran persistent trade and budget deficits, confident that demand for its currency and bonds would continue. The Federal Reserve could respond to crises by cutting interest rates and creating new money, knowing that foreign buyers would still hold dollars. This flexibility helped the U.S. navigate recessions and shocks, but it also encouraged a buildup of debt and a gradual loss of monetary discipline. At various moments, especially during periods of aggressive money printing or financial instability, other countries began to question whether anchoring so much of their financial life to the dollar was wise. At the same time, the global energy landscape was changing. New producers rose. Domestic production in the United States itself increased, especially with the shale boom, altering the pattern of who depended on whom for oil. Alternative energy sources, while still a minority, began to grow. And crucially, new economic powers like China, India, and other emerging markets gained weight in global trade. These rising nations did not necessarily want to live forever in a world where one country's currency held such a commanding role. Geopolitical tensions added more stress. When the United States used its control over the dollar-based financial system to impose sanctions, freeze assets, or restrict access to payment networks, some governments saw a warning. If a country could be cut off from the dollar system for political reasons, then relying on that system completely was a strategic vulnerability. That realization accelerated efforts in some parts of the world to explore alternatives, bilateral trade in local currencies, regional financial arrangements, and, in some cases, experiments with other reserve assets. Alongside these shifts, the relationship with key oil producers also evolved. Saudi Arabia and others began to diversify their partnerships, selling oil not only to Western countries but increasingly to Asia. Discussions appeared about accepting payment in currencies like the euro or the Chinese yuan for some transactions. In a world where energy customers are more diverse and financial options more numerous, the logic of a single currency oil system becomes less inevitable. All of this does not mean that the dollar suddenly collapsed or that the petrodollar vanished overnight. Instead, the erosion looks more like a slow leak than a dramatic explosion. The share of global reserves held in dollars declines gradually. The proportion of trade invoiced in other currencies ticks upward. Long-term energy contracts begin to include more flexibility in how payment is made. The petrodollar system moves from being the only game in town to being merely the biggest game, surrounded by growing alternatives. For observers used to the old order, every small change can look like the end of the world. For others, the process is almost invisible, happening in headlines they ignore and agreements they never read. Yet the direction is clear. The unchallenged dominance of the dollar, built on decades of oil-based demand, is being questioned more openly and bypassed more frequently. This is where talk of the petrodollar dying often comes from. It is less about a single treaty expiring on a specific date and more about the realization that the structural advantages enjoyed by the United States are no longer as absolute as they once were. The free lunch is not instantly canceled, but the bill is slowly, steadily being placed on the table. When the free lunch shrinks, consequences for America and the world if the petrodollar system weakens. What does it actually mean in practical terms? The first and most important consequence is about demand for the U.S. currency and U.S. debt. When oil and a large share of world trade are priced in dollars, countries and corporations naturally hold and use dollars. That constant demand allows the United States to borrow more easily and at lower interest rates than most others. When more trade begins to happen in other currencies, that automatic demand is reduced. It does not disappear overnight, but the floor under it is no longer as solid. For the U.S. government, this means that running large, persistent budget deficits may become more painful over time. Investors may demand higher interest rates to hold American debt if they feel less compelled to own dollar assets for transactional reasons. Higher interest rates make it more expensive to finance everything from social programs and infrastructure to military spending and debt rollover. A country that has grown used to paying for both domestic promises and global power projection with cheap credit may find that the tab is rising. For ordinary Americans, the effect shows up in more subtle ways. If the dollar's external support weakens, then aggressive money printing or deficit spending is more likely to translate into noticeable inflation at home. Imported goods may become more expensive if the currency loses some of its strength. The comfortable assumption that we can always afford it becomes less reliable. Choices that were once easy tax cuts without offsetting savings, new programs without hard trade, all start to carry more visible costs. Outside the United States, the picture is mixed. On one hand, a world less dependent on the dollar might offer more flexibility. Countries doing more trade in their own currencies could gain a bit more independence from U.S. monetary policy. They might be less exposed to sudden moves in the Federal Reserve's interest rates, which currently ripple through dollar loans and contracts worldwide. On the other hand, the transition period can be rocky. Multiple competing systems can create uncertainty, fragmented liquidity, and new sources of volatility in exchange rates and capital flows. For energy exporters, moving away from an almost pure petrodollar world means rethinking how they manage their wealth. Instead of simply recycling dollars into U.S. treasuries and Western banks, they may diversify into other currencies, sovereign wealth funds, direct investments, or real assets. That diversification spreads risk but also reduces the steady, predictable support that the U.S. bond market enjoyed during the height of the petrodollar era. Financial markets, always sensitive to shifts in confidence and structure, may experience cycles of anxiety as investors adapt to a world where no single currency dominates quite as thoroughly. Some may seek refuge in traditional stores of value like gold. Others may look to large alternative currencies, regional blocks, or, in more speculative corners, digital assets. The key point is not that one clear replacement emerges instantly, but that the old system loses its monopoly on trust. The phrase "America's free lunch is ending" can sound dramatic, but it does not mean collapse or apocalypse. It means adjustment. It means that the United States, like other nations, will increasingly have to weigh what it spends against what it earns. Rather than relying so heavily on the rest of the world's willingness to hold its paper, it means that the political conversation at home may eventually be forced to confront trade-offs that were easier to ignore when the petrodollar's support was stronger. For individuals everywhere, this shift is a reminder that the financial landscape is not static. Systems that feel permanent can, over time, transform into something quite different. The challenge is to recognize the change early enough to prepare, rather than assuming that the structures of the last 50 years will automatically govern the next 50. How to think in a changing monetary world when people hear about the petrodollar, reserve currencies, or the end of a financial free lunch? It is easy to feel overwhelmed. These concepts sound distant and abstract, the domain of politicians, central bankers, and large corporations. But behind the jargon, what is really being discussed is the value of the money in your pocket, the stability of your savings, and the rules of the economic game you live under. You do not need to become an expert to respond wisely. You simply need to think more consciously about a world where old certainties are fading. The first step is understanding that no currency, no matter how powerful, is guaranteed to dominate forever. The dollar rose to its position for specific historical reasons: American economic strength, military power, institutional depth, and, at a critical moment, its link to both gold and then oil. If some of those foundations weaken, it is natural for the system to evolve. That evolution does not happen in a straight line. There will be periods when the dollar seems to regain strength, moments when alternative systems stumble, and times when fear drives capital back into U.S. assets. But the broader trend can still point toward a more multipolar order. For an ordinary person, one practical implication is to avoid assuming that a single asset or currency will always be the safest place for all of your wealth. Diversification, a concept often repeated in finance, becomes even more important in a world of shifting monetary structures. This might mean spreading savings across different types of assets, some cash, some productive investments, some exposure to real assets that do not depend entirely on the fate of one currency or one government's balance sheet. The exact mix depends on personal circumstances, but the principle is the same. Do not build your entire future on one pillar. Another important mindset shift is to pay attention, calmly, to long-term signals rather than short-term noise. Dramatic headlines about the death of the dollar or the collapse of the system generate clicks, but they rarely offer a balanced view. Structural change usually happens slowly, through treaties, trade agreements, reserve composition data, and gradual shifts in how corporations invoice their transactions. Learning to distinguish between hype and genuine trend helps you respond with thought instead of panic. It is also worth remembering that every change creates both risks and opportunities. A world where the United States no longer enjoys such a dominant financial advantage might be more challenging for American policymakers. But it could also open space for other regions to develop more resilient local systems. As global finance becomes less centered on a single currency, new avenues for cooperation, innovation, and regional integration may appear. For individuals, that can mean new markets to invest in, new partners to trade with, and new financial tools to explore, always with caution and critical thinking. Finally, there is a deeper lesson about trust. Money, at its core, is a story we tell each other and choose to believe. For decades, the story was that the dollar, backed first by gold and then by oil and U.S. power, was the safest and most reliable unit of account. As pieces of that story change, new narratives will compete to replace or complement it. Your job is not to blindly accept the loudest news story, but to ask careful questions. Who benefits from this system? What backs it? How transparent and fair are its rules? The petrodollar era, with all its benefits and distortions, was one chapter in a much longer history of money and power. That chapter is now evolving, perhaps ending. The next chapter has not been fully written yet. By paying attention, thinking independently, and structuring your financial life with resilience in mind, you can move through this transition not as a passive bystander, but as someone who understands the game a little better. In a changing monetary world, awareness is not just comforting. It is a form of protection.